Well, welcome everybody to the Q1 2022 conference call that we've got in place for you folks. We appreciate you spending time this afternoon to tune in. My name is Jason Fial. I'm an investment advisor with Wild Wealth Management Group. Before we kind of get into the meat of why we're all here, I do want to give some updates in regards to our firm at Wild Wealth and also discuss it's specifically how we're affiliated with Cetera and some of the benefits between us and Cetera, who's our broker dealer. So first and foremost, for those of you folks that aren't aware, we do have a charitable arm of Wild Wealth Management Group that we put a lot of time and effort and resources into. We have a kind of a charitable focus every quarter. And for quarter one, we've got a specific charitable focus. And so this is working with nonprofits and just trying to make a difference in our community. So for Q1, we'll be focusing our efforts on the Girl Scouts all through Q1. If you'd like to donate money, we'll be sending out an email, posting it on our website. Please visit the events page. There'll be a link that you can tune into, but this will be we usually will do something different every quarter, and we're very excited about teaming with the Girl Scouts and trying to make a difference here in the community in Phoenix. We do have upcoming educational events as well. We typically try to do something every month. So we do have an educational event in February, and that's our forecast with our managing partner, Trevor Wild. That is on Wednesday, February 23rd at noon, Arizona time, as well as 6 Arizona time. And then in March, we have a Roth IRA Basics, and that will be on Wednesday, March 30th at 12 p.m. Arizona time and 6 p.m. Arizona time. So we try to bring something of value besides our daily interactions with our clients. And we found that some of these events and some of these topics are very helpful. We gather the feedback from our clients over the years. So we hope that you guys will tune in and find some value in doing so. Most importantly, though, getting into the kind of the meat of why we're all here. And I wanted to introduce Gene Goldman. The topic today is really market forecast in 2022, and there's going to be really 3 specific themes that we want to hit on and really discuss. To give you a little bit of background in Gene and Cetera. So Cetera Advisors is the broker dealer that Wild Wealth Management Group works with. They provide tremendous resource and stability for our group. Lots of resources in terms of just lots of research that we just wouldn't have the capability of doing. And Gene Goldman is a big part of that. So Gene's the investment officer, chief investment officer with Cetera, and he's the director of research. Essentially, Gene's got over 28 years of experience in the development of investment strategies, money manager research, and overseeing investment analysts. Gene's frequently on a lot of national programs, including the Wall Street Journal, Bloomberg News, the New York Times, Forbes, and Reuters, and he's a regular guest on high-profile news networks, including CNBC and Fox Business News. Gene previously was a vice president and market strategist with LPL Financial, where he really helped develop and articulate some market investment strategies. Before this role, Gene was a lead strategist in manager strategy groups. Prior to joining LPL Financial in 1996, he spent 2 years at Liberty Financial, where he was a mutual fund analyst with the research department. From an education perspective, Mr. Goldman earned his Bachelor of Science in Engineering from Worcester Polytechnic Institute and his Master of Business Administration with a concentration in finance from Northeastern University. He also holds a Chartered Financial Analyst, which is one of the highest designations in the finance field. So we are happy to have Gene. Gene, we welcome you. Thank you.
Hey, Jason, thank you. First of all, I'm impressed You actually said the name of my school correctly, I think.
Oh, did I?
Very few people can't pronounce Worcester. It's usually, they think of Worcestershire sauce, or they think of Worcester, but anyways, you said perfectly, it's a Worcester Polytechnic, so thank you so much. So, thank you. What I'll do is share my screen. I do have a few slides to kind of go through. Hopefully you can see my screen here. And again, thank you so much. I know I spoke to a lot of you here probably about a quarter ago, maybe 3 or 4 months ago, and now we're in 2022. So what I thought I'd do for this session is really talk around our perspectives around 2022. From an agenda standpoint, what I'll do is give you a quick recap of 2021. So what happened in the markets last year, and then the meat of our presentation is really the 3 primary themes to drive 2022. So as a reminder, if you look at this next slide, as a reminder, in 2020, so 2 years ago, we saw a very interesting year. Obviously, it was the pandemic. Obviously, we know what happened there. But from an economic standpoint, think about this. We had the longest expansion in the history of our country, 128 months. In the history of our nation, it ended abruptly, and it was followed by the shortest recession we've ever seen, 2 months. So you go from this long expansion to a short recession. Because of this, and the fact that personal income actually rose during the recession, unprecedented. Usually you have a recession, income falls, personal income rose. Also, it was a services-led recession. We still bought TVs and Pelotons and everything out there, but it was a service-led recession. You take all this, shortest recession on record, you take the services-led, personal income rose. And the result is that it's just created this economy that we are in right now. It has a lot of ramifications for this current economy. So if you take a look at the stock market last year, okay, the stock market, the S&P 500, it's a market benchmark. It was up about 27, 28%. It had a great year. And the year was really good for the stock market. But what was interesting is that we did not see much market volatility. Stocks throughout 2021 generally just moved higher. And what we did see, on the other hand, and I've indicated on the slide here, are those red circles. Every time the S&P 500 fell to its 50-day moving average, boom, all of a sudden these retail investors, these buy the dippers as they're called, jumped in and bought stock. It was like a signal. If you see these circles, 10 out of 11 of these circles, 10 out of 11 times that the stock market hit its 50-day moving average, basically went in and stocks bounced right off. So this helped to create a very low market environment, low market volatility. If you look at this next slide, despite the fact that markets were less volatile at the top, underneath the market, within the market itself, it was a very volatile environment. This slide has a lot of stuff on here, but the key thing to look at is at the bottom. On the bottom, you see a purple line. The purple line goes up. That's value outperforming growth. And then it goes down. That's growth outperforming value. So in one given year, we had value surge and then growth surge. And then you think about this. In the last 6 months of 2021, large cap stocks were up about 8%. Small cap stocks were down 4%. So while we had a good year in the market, underneath the market was a very, very different type of environment. And it's very, very important. And we'll talk about this a little bit later. If you look at the bond market, we had a rarity. So what we saw was one of the only down years in the bond market. Basically, as this slide shows, it was the 4th time the bond market was actually negative since 1976. Just how rare is that? Bond market was actually negative. Again, it's a very different environment we're headed into, and these are all important to lay the foundation for 2022. So 2021, we laid out 3 themes for you. Remember, we talked about this. We said, number one, that basically economic growth is peaking. Economic growth has surged. Now it's starting to slow down. Our second theme is the fact that inflation is less transitory than the Fed claims. Remember last year, the Fed, Jerome Powell kept coming out saying, we are in a transitory inflationary environment. And there's some reasons why he said this. Clearly, inflation is not transitory, and I will give you so much evidence to support this. And number 3, our third theme was market volatility will increase dramatically. If you look back at 2021, we were right in 2 out of 3 themes. Where we were wrong was market volatility. Market volatility did not pick up at all. So as we pivot into this year, our 3 themes are similar, but they're very important. Number 1, economic growth will slow. But, and here's the important but remain above pre-pandemic levels. And there's many reasons why. We've got so much stimulus in the economy. vaccinations, we've got consumer wealth, and I'll talk about those a little bit later. The second theme is that the Fed needs to really catch up. The Fed made a mistake last year. They came out and said inflation is so transitory. They were completely wrong. Now they are playing catch up. We'll talk about what that means. And third of all, just like last year, we do believe market volatility will pick up. Markets are going to swing up and down. I know this year we're seeing this already in these big market swings. We really believe it's going to take place this year. So let's go to this first theme. And the first theme is economic growth will slow but still remain above pre-pandemic levels. I showed the slide to you before, and this slide is such an important slide. What I've done is I've taken the last 9 economic recessions and economic recoveries, and the beginning of the recovery starts at point 0 on the far left-hand side. And you see is that the dark black line on the top, that's our current recovery. So compared to the last 8 recoveries, the recovery that we're in right now has surged like gangbuster. It has been so strong. Our concern is that the economy, that economic growth will start to slow down a bit. And this is normal in an economic cycle, especially as we transition from an early to a mid-cycle recovery. When this happens, year-over-year comparisons start to become difficult, interest rates start to rise, and what we're seeing right now, supply chain issues will linger for some time. Again, the economy is strong. We don't see a recession. All we're saying is that it's starting to slow down, but still be above pre-pandemic levels. So why are we saying it's going to start to slow down? Well, you look at this slide, and this slide is a busy slide, but it's so important. And I know we've talked about the ISM before. The ISM is one of the most important data indicators out there. So ISM, it stands for Institute of Supply Management. And what it is, it's an index. It's called the Purchasing Managers Index. And what it is, it's a survey of purchasing managers, whether they're in manufacturing or services companies, and they're basically asked a bunch of qualitative questions. Is business good? Is it bad? How are the new orders? How's hiring? How's firing? How are prices? How's inflation? A bunch of qualitative questions, and they're merged together. And whenever this index goes above 50, it's expansionary. Below 50 is contractionary. And this slide exactly shows that the data is starting to slow down. So what we've done here is we plotted on the 2 lines at the top, we plotted new orders and we plotted a business activity. Both of these are well above 50. They're both expanding, but they're rolling over. The data is starting to slow down. The data is still really good. All we're saying, the data is starting to roll over. As a side note, that little blue line on the bottom, that 46.7, that's inventories. And you can see that, the supply chain issues that we're having in this economy is affecting this number. You can see that basically it's below 50, it's contractionary. But the good news is that we're starting to get closer to that 50. We'll talk about supply chain issues in a second. Also, just recently, we did get a report called the Empire State Manufacturing. And I know a lot of you are in Arizona and you're like, well, I don't really care about the Empire State. Why do I care about manufacturing in New York? Well, this is probably one of the most important reports because it's the first look at the current month's economy. And this data point just came out. And what it is, the market expected a positive 35 reading. And don't worry about what that means. Basically, anything above 0 is good. The number came in at negative 0.7. The market was completely surprised. Again, the first look at the current month's economy, at January's economy, is showing the data is starting to slow down. If you look at this next slide, what's also going to impact the economy, again, start to slow our economic growth, is that we are in a very tight labor market. You know this, I know this, we see this data so much. Whether you look at jobless claims, you look at new jobs, in this case, you look at payroll reports. Think about this. We lost about 22 million jobs in March and April of 2020, and we've recovered about 19 million of them. So we lost 22 million, we've recovered about 19 million. Right now, there's about 3 million jobs that we haven't gotten back yet. And what we really expect that those jobs are going to take a long time to get back. You can look at a lot of people who took an early retirement because the stock market had done so well. There's obviously concerns around COVID, around childcare. At the end of the day, and you see this in wages, we do believe that the tight labor market, where the unemployment rate today is about 3.9%, we do believe this labor market is going to overhang the economy and really start to slow our growth as it gets very difficult to find new workers. So you're probably saying, okay, well, he's talking about this bad news that the economy is doing well, it's all starting to slow down. Well, why don't we expect a sharp drop in the economy? Why don't we think things are going to go into a recession? Well, there's a lot of great things to think about the economy. First of all, you think about consumer demand. We as a consumer, we are demanding, we represent about 70% of the economy, and we are still spending money like crazy. If you look at our net wealth has risen dramatically in terms of the stock market, in terms of home prices. If you look at debt to income levels, very, very low levels. The consumer is in great shape. Also, if you look at this slide is very important. Supply chain issues have really impacted our economy. And again, that's just a difficulty trying to get, a bike, a TV, whatever you're trying to get. It's very difficult out there. And what this has created, this ratio called the inventory to sales ratio. And what this simply is the inventory of inventories divided by sales. And as this line moves lower and lower, that means inventories are falling faster than sales. And this makes sense because there's a lot of difficult supply chain issues. But what we notice and what we see in recoveries all the time, as we transition from an early cycle to a mid-cycle recovery, what happens? People start to spend a little bit less. Or in our economy today, we start spending less on goods and more on services. As this happens, and again, the economy goes from early to mid-cycle, businesses are going to use the opportunity to start to rebuild back inventory. And this is going to be huge. This is going to be very good for the economy. So again, this is one reason why we don't see the economy dropping dramatically. The other reason, as I kind of alluded to earlier, we as the consumers, we are in great shape right now. Again, the consumer is about 70% of the economy. And again, consumer wealth has surged dramatically. Our wealth has surged dramatically. At the same time, we have very low debt to income levels. And you see this here, these two lines. One is the top purple line is basically overall debt to income, and you see it come down dramatically. And the blue line is a mortgage debt to income, and that's come down dramatically. We as consumers are in really good shape right now. So that's the first theme. The first theme is, again, that the economic growth in our economy is going to start to slow down, start to roll over a little bit, but still be well above pre-pandemic levels. That's great news. Let's pivot to the second theme. And the second theme is really around inflation and the Fed. So as I mentioned before, 2021, when I think I spoke to you 4 times last year, 2021, every single time, I kept saying, inflation is transitory. It's not going to be as short-lived as the Fed claims. And the Fed had many reasons why they thought that. Part of it was just difficult year-over-year comparisons. Part of it was coming out of the recovery, people would stop spending stuff. What they really underestimated was the fact that the labor market was tighter than they anticipated. Also, it was very difficult from a supply chain issue. Also, just a surge in wage and sticky inflation. Now, let me talk about that in a second. So if you look at the inflation issues, there's 2 primary inflation things we look at to show that the Fed is wrong. And I'm not trying to say how they're wrong, but all we're trying to say is that things that the Fed really missed. Number one, the tight labor market has created really high wage inflation, wage growth. So you look at the slide, and this basically slide shows 3-month moving average of wages. And you see the line is moving higher. Wages have surged dramatically. I think wages over the last 12 months are up about 4.7%. Just to put this in perspective, leisure and hospitality businesses, they've seen wages jump over 14%. Professional services business have seen wages jump 6.2%. There is a lot of wage inflation in our economy. Again, this puts pressure on the economy. This creates more inflation as people with more wages spend more money, again, creating more overall inflation. The other way they've been really wrong, the Fed's been really wrong, and it's important because this is a huge one, is that sticky and long-lasting inflation is lasting longer than they anticipated. And the best example is the surge in owner's equity rent. So if you look at this slide basically shows owner's equity rent. And you see on the far right-hand side, it has surged dramatically. What happened here is that home prices in the last 2 years, the median home is up about 32% in the last 2 years. Home prices have done really well. What unfortunately has caused is actually pushed out first-time buyers. First-time buyers are like, heck, I can't buy this home. It's too expensive. So what they do is that they've gone back to renting. And now there's a demand on rental properties, higher demand, law, supply and demand, higher rental demand pushes rent higher. And rent is a very sticky inflation. And this is where the Fed kind of missed it. If you think about CPI for rent, so CPI is a consumer price index. And in 2021, rent on average was up 4.2% year over year. Is that high? It is very high. It's the highest since 2007. So you've got this sticky inflation. Rents really don't come down that much. So the sticky rent inflation is going to last for a very long time. And then you think about this. If mortgage rates are rising, it becomes more expensive for consumers to buy homes. What they're going to do? They're going to go and rent, and this is going to create more demand on rent, pushing rent higher. So again, this is something where the Fed really messed up. Number one, wages, and number two, the sticky wage inflation. So you take all this, and this is not me trying to say, Fed, you did a bad job. All we're trying to say is this leads us clearly to our second theme. And the second theme is that the Fed was wrong, but now the Fed needs to play catch up to really address their inflation mistake. So you think about the Fed, and the Fed, they have what's called the FOMC, their meeting where they decide interest rates, and they really control one main interest rate. They do a bunch of other things, but they really control one interest rate called the Fed funds rate, FFR, Fed funds rate. Every year they have 8 scheduled meetings, and of those 8 scheduled meetings, this is where they decide direction of interest rates. They have 8 scheduled meetings, and of those 8 scheduled meetings, 4 of those meetings have what's called a dot plot. And I'm not going to really go into the weeds, but the dot plot is basically this anonymous Fed document, this document that takes anonymously all the Fed members' expectations on interest rates, expectations on inflation. And what happens is that the median data point becomes what is the Fed's overall outlook towards inflation and interest rates. It's an important document, very, very important document. And it's really watched closely by market participants like us, you, wealth management, because we're watching where is the future trajectory of interest rates. So if you look on this slide right here in the middle, basically for 2022, and I took the last 3 dot plot meetings for 2021, but for 2022, in June of 2021, the Fed said we would raise rates maybe once in 2022. In September, 3 months later, they now say we will raise rates between 1 and 2 times in 2022. Then the most recent Fed meeting in December, they came out and said we are going to raise rates 3, maybe a little bit more, but at least 3 times. This is all in the course of 6 months. The Fed dramatically shifted because inflation became much more sticky than anticipated. The good news is the markets were like, okay, we expected this. We think the Fed it makes sense for the Fed to raise rates 3 times. The problem is this slide. You look at the slide, and this slide, and I know I'm getting into the weeds a little bit more than we really want to, but it's important. This is the 10 to 2-year spread. And what this is, it's the 10-year Treasury yield and 2-year Treasury yield. And it's basically taking the 10-year, which should be higher than 2-year, and subtracting out the difference. And when the Fed raises their short-term rates, what it does, it pushes the 2-year rate higher. And theoretically, it slows the longer rate down, because theoretically, if short-term rates are moving higher, long-term rates come down because there's less inflation, because the Fed is raising rates. The Fed is looking to slow the economy down. And you can see here on the right-hand side, it makes sense. You see the line is moving lower and lower because the Fed is talking about raising short-term rates. And at the same time, the 10-year rate is starting to move lower and lower. So that spread between the two is falling dramatically. Why is that important? Well, you go to this next slide. And the next slide, this is probably the most important slide I'm going to talk about in our whole session. In the December Fed meeting, the Fed came out and said, we are going to basically raise rates 3 times in 2022. And the markets, as I said before, were like, okay, this makes sense. We see this. But then earlier this month in January, the minutes of that December meeting were released. And the minutes are usually someone takes notes and they talk about what everyone said and so on and so forth. The minutes shocked the markets. And yes, the minutes said we are still going to look to raise rates 3 times in 2022. But, and this is the most important point, they added a new section called the discussion of policy normalization considerations. That's a mouthful, but what it is, it's an unexpected section that the markets had not expected. So the markets were freaked out. And why were they freaked out? Well, let me show you this chart. If you look at this chart plots 2 data points. The purple line is the Fed balance sheet, and the light blue line are the average 30-year mortgage rate. So if you think about, remember we talked about this, so back in March of 2020, the Fed came out and they did what's called quantitative easing. And quantitative easing, we talked about this, remember this, it's basically the Fed going into balance sheets of banks and institutions and saying, I'm buying that mortgage, I'm buying that treasury, I'm buying that security, and then replacing it with cash. When they replace it with cash, what happens? Basically, banks have more cash on their balance sheets, supply and demand. What they want to do, they start lending out the cash, and this helps to lower interest rates, and this helps to really open up the bond market. It proved immensely successful. But the problem is that with the Fed buying these long-term mortgages and treasury securities, it's artificially keeping longer-term rates low. And if you think about mortgage rates, the 30-year mortgage rate tends to be based on the 10-year treasury rate. So now, if the Fed wants to raise short-term rates, it's great, but it doesn't really affect the key rates to slow the economy down, like a 30-year mortgage. So what the Fed did in these meeting notes that surprised the markets, again, this discussion of policy normalization considerations, the Fed talked about reducing the Fed's balance sheet, and they wanted to initiate this reduction coming after the first rate increase of next year. So what the market basically said, what the Fed basically said to the market is, surprise, we are going to start to reduce that purple line on this slide because we want to push long-term rates higher. And this is why the market sold off dramatically. Technology stocks have sold off. Why yields have moved dramatically. Again, what's going on here is something called quantitative tightening, where the Fed starts to get rid of those treasuries and mortgages. By doing this, this pushes longer rates up, which also pushes mortgage rates higher, which also pushes home equity loans higher. Again, this is what the Fed is trying to do right now, and the market did not anticipate this until probably middle of next year. Now the Fed is saying maybe early next year. So again, this is the important point. If you look at the slide, a lot of times, a lot of you have asked, hey, how do I know what the Fed is doing? What is the Fed's plans? One thing we always look at is the 2-year treasury yield. I applied this here. The 2-year treasury yield is a great rule of thumb to say, what is the market's expectation of the Fed funds rate to be 1 year from now? And you see on the right-hand side, this has surged dramatically because, again, the Fed is saying we are going to be raising short-term rates, and we are suggesting 3 or maybe 4 times. So, again, this is our second theme. The theme is that the Fed has gotten more aggressive. The Fed needs to really play catch up because they've been so much on the sidelines for most of 2021. And now they realize inflation is less transitory and there are more issues facing the economy, especially around inflation, especially around wages, especially around sticky inflation. So that's the second theme. Again, the first theme is the economy slows down, but not anywhere near to pre-pandemic levels. Number 2, the Fed plays catch up. Number 3 is really around market volatility is going to increase. So if you think about the economy, okay, the economy today, on the positive side, we got a lot of positive news. Vaccinations, for example, I think it was like, we just crossed 80% of people over 5 years old now have at least 1 dose of the vaccine. That's great news. We also have seen about 23% of Americans have a booster shot. So that's good news there. What we see this leading to is the fact that more people get comfortable going back out to shop, going back out to work, back out businesses. This should really increase our labor participation. We also feel supply chain issues are going to start to alleviate more and more, start to get open. And I'll spend some time a little bit on this later. But again, you've got vaccinations, you've got supply chain issues. You also have the fact that even though the Fed is looking to reduce stimulus, there's still going to be some stimulus in the economy until the Fed is completely done. So we'll still have this positive stimulus in the economy. On the negative side, what we've talked about before is the Fed has to play catch up. Again, they need to raise rates faster than they're saying. They need to start to undertake quantitative easing faster than they've said. All we're worried about is that the positives and the negatives, the markets really don't know the timing of all this. And this is going to create a lot of market volatility as the markets try to figure out when is the Fed going to raise rates more, when is quantitative tightening going to start. You layer on top of this is this slide right here. This slide shows valuations of the S&P 500. Again, the S&P 500 is a stock market index. And you see valuations. This is price of the index divided by earnings. And the higher the line, when the line moves higher, the valuations are higher. When it moves down, valuations are lower. What you see from this slide is that valuations are at near tech bubble levels. Remember back in the late 90s and early 2000s, we are at tech bubble levels. The good news is that you can support higher valuations with low interest rates, with low inflation. But the fact is, inflation is rising, has risen, and interest rates are rising. So again, this is going to put pressure on valuations. The other point about this slide is that this slide prices in absolute perfection in the stock market because valuations are so high. Everything needs to be exactly perfect. Timing has to be perfect. The Fed has to engineer this re-engineering of the economy. Again, lots of things to be following, to be concerned about. If you look at this slide, we also have what's called poor market breadth in the stock market. So the stock market has had a great year. 2021, we saw a great year in the stock market, but when stock market's rising, you want to make sure that the majority of stocks are moving in the same direction. And what you're seeing here is that for the NASDAQ composite, for example, while the NASDAQ composite had a great year last year, only about 34% of stocks in the NASDAQ composite were actually above their 50-day moving average. So what does this mean? This means that while the overall stock market was moving higher, the participation of stocks was pretty low. This really means that basically a handful of those largest big name technology stocks really drove market returns. Again, not a very healthy market. If you look at this, you think about this. So this slide shows earnings growth. And you think about the rules of investing. When earnings rise, people tend to buy shares of the companies of those earnings. So in essence, really earnings help to drive stock prices. And you see here, earnings have been very strong. You saw, for example, in Q2 of 2021, earnings were up about 92% year over year. Great news. And it was driven by the economy, the recovery, stimulus, and just the overall reopening. Great news. But what worries us and why we think market volatility is our key third theme is that earnings growth is going to start to slow down pretty quickly, pretty fast. You see this on the right-hand side. You see the earnings are falling quarter by quarter pretty quickly. One fundamental reason why we think about this is this slide here. And we grabbed this slide from our friends over at Yardini. And what this shows is that this line shows that profit margins for the S&P 500 companies are at record levels. So basically, optimism around the economy, basically, strong growth has really helped to push these profit margins higher. But margins are clearly going to be under pressure. We have rising wage costs, rising labor costs. We also have rising energy costs, rising borrowed costs, and of course, supply chain issues. So you take all this together, we do see profit margins are going to be under pressure. Yes, they will be supported by productivity and technology at the end of the day, but we do believe profit margins at a record high right now will be under pressure. For a company to succeed in this type of environment that we foresee on a go-forward basis, they really need to raise prices because if profit margins are coming down to maintain these same strong profits, they really got to raise prices. But it's going to be very difficult. You look at this slide. This slide takes producer prices, so sort of a proxy for business costs, and then it subtracts out consumer prices, basically what companies can sell to consumers, basically selling price. I know it's not a perfect apples-to-apples comparison, but it's a great proxy to say, okay, company costs are rising. Are consumer prices, what consumers can be sold to, are they rising at the same rate? And the answer is no. Business costs are rising faster than they can push those costs onto us as a consumer. Companies are going to have a difficult time from a margin standpoint maintaining profit margins on a go-forward basis. If you look at the stock market valuations are high. But then if you look at the bond market, valuations are high in the bond market too. What this shows, credit spreads for high yield bonds. And basically, this is the spread of a riskier bond called a high yield relative to a comparable treasury. And when that line gets smaller and smaller, when this line moves down, that means the compensation to invest in a riskier bond comes less and less. This is basically means they're expensive. And you can see bonds are pretty expensive, and bonds are what we consider to be the safety in our portfolio. If you look at this, interest rate sensitivity. So there's something called duration. So duration is a fancy word for interest rate sensitivity. And what this means is it's basically how sensitive is the bond's price to interest rates. So long story short, we won't go into it this time, but basically when yields move higher, bond prices come down. And what this attempts to do is measure that sensitivity in terms of a yield moving higher and bond price moving down. And what you see here is that in the bond market, duration is at record highs. And you see it's at 6.7 years. So what this means is that if let's say if bond yields, if interest rates move up 0.5%, bonds could fall about 3.5% in essence. So all this is saying that is that we are in a very difficult bond market too. So we're in a difficult stock market. We're in a very difficult bond market. Again, it's becoming a very different environment that we're headed for on a go-forward basis. And if you look at this slide, are yields going to move higher? Our answer is they probably are. We can't say definitely, but they probably are going to move higher pretty quickly. Think about the beginning of the year, the 10-year Treasury yield was at about 1.5%. Today now it's at about 1.84. It's up, 1/3 of 1% in less than 18 days. And you see the slide here. The slide plots two things. It plots CPI inflation, so inflation in those purple bars, and then the blue line is the 10-year Treasury yield. These two move closely over the long term. They move very closely. The 10-year Treasury yield has not moved up yet. It has not caught up to CPI yet. It will, in our opinion, sometime soon. It's already doing this. So you take all this information, and what does this all mean? And I'm not trying to scare any of you. I'm not trying to scare any of you at all. What we're trying to say is that valuations are high in the stock and the bond market. We've got some poor market breadth. We are at record level durations. All this suggests that the stock market and the bond market are priced to absolute perfection. They're pricing in the best case scenario taking place. And it leads us to our third theme is that we feel that because this perfection is being priced in, this will lead to higher market volatility. And the second point about that, and it's important, and not to scare you, but it's our opinion that a potential market correction, and a correction is where stocks fall 10% or more, increases every day. The chances of a correction increases every single day because of the factors I laid out to you before. So before you get scared about the correction, think about this. A correction is a normal part of the market. On average, a market correction happens about once every 8 months. And we haven't seen a correction since February of 2020. So again, that's good news there. Second of all, a correction is a good thing for a market because there's a lot of investors on the sideline, a lot of cash on the sideline. They're ready to get in, but they just want to get in a little bit more of an attractive price. Corrections are very, very healthy for the market. On the other hand, though, what we don't see is a bear market. So a bear market is a correction's ugly cousin, where a stock market falls over 20%, and it falls in a very ugly manner. We don't see a bear market at all, okay? And the four reasons why. Number one, as I mentioned before, we have a lot of stimulus in the economy. So even though the Fed is starting to reduce stimulus, there's still a sizable amount of stimulus in the economy. Number two, consumer. We are in great shape from an income, from a stock market, housing market. Number three, low debt. And number four, supply issues will start to abate. And it's something I wanted to talk about. So if you look at this next slide, and this is so important. Okay, the slide shows the impact of supply chain issues on our economy. So this is the Port of Los Angeles, and this shows the shipping container count year over year. And you can see it surge dramatically during 2021. That's that big hump on the right-hand side of the slide. And now it's come down quite dramatically. Supply chain issues are starting to improve. That's good news. So this helps to reduce some of the inflation. This really helps to improve sort of the sales within our economy. Again, one reason why we don't see a bear market. But more importantly, let's go back to this slide. Let's go back to this data point. Remember we talked about ISM? So within ISM, remember above 50 is good, below 50 is bad. There's also what's called the ISM Supplier Deliveries Index. And what this shows is that purple line on the far right-hand side, this surged dramatically during 2021 because supplies were hard to get. It was very hard. We had supply chain issues. Now we're still above 50. It's still expansionary, but the numbers have come down dramatically. All this is an example that supply chain issues are starting to open up. And we excuse me, my dog right there. Sorry, my dog is worried about his supply chain issues around dog food and treats and so on. But some apologies for that. But think about supply chains. We really believe supply chain issues are going to alleviate, not just because what this data says here, but a couple of reasons. Number one, as we start spending less on goods and more on services, more on vacations, more on trips, and other things like that, that helps to reduce some of the supply chain issues around goods. The second issue is that one thing that's really been impacting our supply is really Chinese consumers. Chinese consumers have been buying a ton of goods, and because of this, they really impacted supply chains, Chinese consumers in China. With the Chinese New Year taking place on February 1st, after that, we do believe, if you look at year-and-year data, the highest point for Chinese purchases of goods tends to be around the Chinese New Year. And the Chinese New Year is around February 1st this year. We will start to see some of those supply chain issues start to alleviate ever so slightly. So again, number one, we start purchasing more services, more experiences. Number two, supply chain issues, because the Chinese consumers will start to purchase less and less goods. So with all that said, what does all this mean? Okay, first of all, I'm not trying to scare any of you. All I'm trying to say is our three themes for 2021 are economic growth is slowing, but it will still be above pre-pandemic levels. That's great news. Number two, the inflation, the Fed needs to play catch up. They're a little bit behind the eight ball right now. They are going to start to be more aggressive in terms of their policy. And number three, expect a lot of market volatility. Things are going to be swinging all over the place. You look at the market today, the Dow is up down 550 points. Again, big swings in the market. Expect to see that on a go-forward basis. And what does this mean for you? Two things. Number one, first of all, be diversified, okay? I know it's a kind of a boring strategy, but it's so important. Diversification is allocating to lots of different parts of the market based on your risk tolerances. So a little bit in growth, a little bit in value, a little bit international, a little bit in fixed income, wherever it is to be appropriate to your investment objective. And number two, make sure that the team at Wild Wealth Management knows your investment objective, that they know everything about you. Make sure that if there's any changes in terms of your liquidity needs, your other needs, anything that you need, make sure that they're in touch with you, because we are in a very different market. We are in a market where things are going to start to slow down, where things are going to be volatile. And they need to make sure that your portfolios are absolutely aligned to your long-term investment objectives. So Jason, with that, I think that's really it.
Yeah, thank you, Gene. Such good information, and we appreciate all the knowledge you bring. Our partnership with Cetera, so helpful in helping us run our practice here. And I would second what Gene mentioned as well. I mean, look, the reason you work with an advisor is because things are different year to year, right? 2021 is different than 2022, and there's different things that play out, and it's really important that you have conversations with your specific advisor about your situation, about changes. Even just our take, and kind of furthermore expanding on some things that Gene touched on specifically for you. So speak with your advisor, have conversations, let us know when things change from a household perspective. But Gene, again, thank you very much. We appreciate your time and effort, and thank you all for joining us, and we look forward to seeing you next time. Bye-bye.